Hey guys, welcome back to the Real Estate Huddle, episode 23. And now we're going to talk about the 10 commandments of lending, or the things not to do when you're getting a home loan. And we're going to talk about those because if you're going through the buying process, you'll probably feel like it's a bit invasive at times, right, with your financials. And it can be sometimes uncomfortable, it can be sometimes just irritating because lenders continue to request more and more things sometimes. But if you do these 10 things, you will definitely be in a better spot.
If you don't do these 10 things.
Yes, if you don't do these 10 things, it will go so much smoother than if you were to make any of these grievances. So let's start from the top, shall we?
So we're just going to go right into the commandments?
Let's go right into it. Yeah. So, and then we can comment on these as like we've seen things, you know, with the buyers that we worked with.
I'm going through this like as we speak. Mm-hmm. High level, the way I think about it is like the bank has made, you know, their estimate on the level of risk you bring them. Mm-hmm. So anything you do can change that. And you don't want them to change that really either way. Mm-hmm. So in the background, it's a hard situation. It's a tough process, but
that's a good way to explain that.
Don't give them a reason to think that you're more risky than you are. So that's kind of the preamble.
That could be the clearest way someone's ever explained that. It's that Cornell education going to work. Chad, why don't you start it from the top?
10 commandments. Sorry, I closed it. The 10 commandments for a smooth loan transaction. Number 1, thou shalt not change jobs, become self-employed, or quit your job.
Okay.
Same thing, right?
Yeah.
Changes your level of risk. Don't do that.
Yep, exactly. Yeah. So the bummer is because we are all either like a business set up as a business owner or independent contractor, right, in this business in real estate. And so we get kind of punished, in any small business owner or independent contractor, salesperson, sometimes that's not on W-2s, can get punished if they switch from W-2 income to income via 1099 form, right? And so lenders don't like that per se, because that's a general statement of here's what I earned during the year, but it's not guaranteed monthly by your employer or anything like that. And so much higher risk, like you said, Chad, you know, and that's what lenders kind of flinch at, you know, and typically about 2 years time frame is what lenders want to see before they'll qualify you. And they just basically take your income for 2 tax returns if you're 1099 and divide it by 24. So if you have 1 year that's kind of a weaker year, you're just getting started with your company, and then the next year is really good and stronger, they'll take the average of the 2 years. And so that's why, you know, you get penalized a little bit until your business is really cooking and consistent. Then you're fine. You know, it doesn't make a difference. But especially at the start, and it's interesting because a lot of people that start businesses or that are on 1099s, they tend to be pretty ambitious, like go-getter type people. And then they get super frustrated with lenders in the lending situation because it's not conducive to them, you know, especially at the beginning of their journey on their business. So a couple of good things to know there. There are loans that are just bank statement loans that are out there right now that basically qualify you based on how much cash flow you have in your business. So they tend to be a little higher interest rate. But there are loans that exist like that can work around that a little bit. So that could be another alternative solution. But bottom line is, as much as you can just keep it steady, keep your income the same, that'll help you down the road.
And some people I know, if they're looking to make that career change, they say, oh, well, you know, I'll make this career change and then I'll buy the house after. But like you're saying, if you're going to be a 1099, your own business, you're kicking that can down the road at least 2 years before you're able to buy a home. Or you could wait 60 days, buy your home, and the day after closing, start your new business, and it won't affect anything.
Yep. For sure.
We have too many examples. I'll try to keep it quick. But what we're going through now is my clients earn an hourly rate. They're getting paid more, but just the transitionary period where they're not working, you get a new bank statement, and their availability for that loan went down based upon a snapshot in time, which has not reflected all the future. So I think that's the thing. Sometimes the bank does not take this long-term view. It's snapshot. Anyway, we can not to belabor it.
Definitely. All right, you want to go to the next one? Number 2?
Yeah, thou shalt not buy a car or a vehicle or really any large purchase for that matter. But I know you have kind of a personal anecdote with this one.
One of my most crushing memories in helping people in real estate to buy a house. I was showing a friend of mine, his name's Chris, homes back in like 2000, this is like 2015, 16, somewhere around that time frame. And we were looking in the Plum Creek golf course and a townhome that was over there on the golf course. He had bought it. It was under contract. I think we were under contract for about $255 for a townhome back then. And it was a nice place on the backing to the course. I think it was a 2-bed, 2-bath, but great location. HOA was reasonable. It was a good spot. And during the process, during the inspection, it was like the first week of the contract period when he's getting all his loan docs to the lender. He shows up to the inspection in a bright, shiny, new orange Jeep that was
Bronco.
like Jeep Wrangler, brand new. And I looked at him. I said, "Is that new?" And he's like, "Yeah." I was like, "Okay, did you just buy that?" And he's like, "Yeah." And I was like, "Okay." And the lender got talking to him, and I guess that put him over the threshold of his debt to income ratio. So now he had too much debt because of his $800 car payment, and now he can't afford the, I think it was like a $1,600 or $1,700 mortgage payment now because of the car payment. And I just told him, I said, "Hey, okay, let's sit down, let's talk about this, because like this is a sweet Jeep, it's awesome, looks super cool, it's got the big wheels and everything, like all the bells and whistles and stuff." I just said, like this value, like in the first 4 years, you're probably going to lose about like 75% of your value, right? When you buy a brand new car like this. And so, that value is going to go down. It's a depreciating asset, right? Which is really a liability for you because you have this payment and you don't really own it yet. The bank does, right? So you got that compared to this unit here in the next 4 years is, if it's average appreciation, it's going to be great.
Did he bring the Jeep back?
No, he kept the Jeep, terminated the contract, lost the house. And I looked at it like four years later to see what had happened with the value of that place.
Ooh, that's a bad idea. You shouldn't have done that.
It was during our surge, like after the Broncos won the Super Bowl in 2015 and marijuana was legalized in Colorado, our market went boop, right? And it just like took off. And so we had like 15% in 15, 18% the next year, 16% the next year. I mean, it was like mid-teens appreciations every year. And I mean, basically that place was worth like $450 to $475 in 4 years compared to $255.
Did you tell him this when you looked it up?
No, I didn't.
So on the flip side of that, one of my son's roommates, young man, but he's in insurance, so he understands all the actuarial tables of risk. So before he was getting ready, which he didn't choose to do, before he was getting ready to buy, he took that big old Ford 250 he had bought, traded it in to get a used, Jeep Wrangler or Jeep Cherokee or something to bring his monthly payment down like $400.
And then did he go back and buy the truck after he bought the house?
He did not.
No.
Well, no, he hadn't bought the house yet anyway. But it just shows he's a smart guy.
Smart.
Understand depreciating asset bad.
Yep.
Appreciating asset good.
Totally. Yeah, we've worked with other people like that too that have like, hey, I'll do whatever it takes. I'll sell my car, I'll sell my boat to make it happen, and they'll sell something, and then that payment drops off, and now they can qualify, or their price goes up, and they can get the home that they really want.
I had one experience where it didn't turn out as bad as they thought, but they did buy a car, and the lender found out, and he's like, they got so lucky because it put them at like 0.01% below their DTI. He's like, they can still get the house, but like, I mean, he's like, they shouldn't have done that. And they lucked out. So it doesn't happen that way every time. Most of the time it does, where it's like, and I don't want this to be like, yeah, you should go buy a car. Mm-hmm. But it's like, if for some reason you don't know and you make a mistake, sometimes it doesn't always turn out that bad, but most of the time it does.
Yeah. And lenders are people too. You will give your lender nightmares if you tell them you just bought a brand new car.
I'll have a heart attack right then and there.
On the other end of that, sometimes paying off your car that you currently have can be beneficial for you for your qualification. So on the list of things to do talk to a lender, and that could be an option as well.
Yeah,
Yep.
definitely. All right. The third commandment of lending, thou shalt not become late on any payments. All right, that's a good one. So there are certain weights, right, based on the different types of payments. If it's a credit card payment, it may be one drop in your credit score, maybe 20 to 50 points, right? If it's your mortgage payment, that is the worst thing to be late on. So you don't want to be late on that, because that can be sometimes up to 100, 150 points on your credit score if you're late on that. Mortgages they don't report anything until 30 days late. And so you can be 15 days late and just incur no penalty. You can be 16 days late and incur a late fee, right, up to 29 days. But when you're 30 days late, that's a notice of default that goes to the credit bureau, and you go on this list of notice of defaults. And so you'll start getting calls from investors saying, hey, are you in trouble? Do you need me to buy your house with cash and get out of it? There's all kinds of fun things when that happens. It goes on Zillow as a pre-foreclosure. Did you know that? If you're 30 days late on a payment, even if it's an accident that you forgot to pay. I've done it twice, you guys. Leaving town, I'm horrendous about checking my mail sometimes, and so I'll get behind on my stack of mail. We were traveling to go see my wife's family in Spain a long time ago. This is probably 8 years ago. And we were there for 3 weeks, and I got back. I didn't catch up on my mail right away. And I thought we were on auto pay, and we weren't. And our payment didn't get paid. So I was on the notice of default list on our first house, on our mortgage. And I was absolutely just livid, right? Like, I was trying to do everything I could to reverse it. It's like really hard to reverse. So just staying on top of those, making sure you're not making late payments on any other real estate you own. Vehicles is probably worse than a credit card. Those kind of things can ding you. Your landlord can file a credit ding on you for not paying your rent on time. So just making sure that you're making your payments on time, that'll keep you in good graces with the lending world.
I think I'm on the wrong one.
I got you. Number 4, right there.
Make sure this is the same thing. All right. Thou shalt not reduce account balances below what you told / provided to your loan officer. All right. Below what you told
That's
provided.
a little oxymoronic. No?
Yeah. I was like, wait, shouldn't you do that? Thou shalt not reduce account balances.
That's for like your checking accounts and stuff. So you have a certain amount of cash in the account.
Oh, yeah. The amount of cash you have. That's all talking about cash on hand. Yeah. Because you do have to report that to your lender. They're going to ask you how much cash you have.
I think that was my example. They asked for an updated, now that they've been in contract, they asked for updated account statements. They haven't been working, so they draw that balance down because they've been living off it.
Yep. Yeah, and we'll talk about some other things that have to do with that as well, with like the amount of money you put into an account versus like the amount of money you take out of an account. All those things can come back to bite you a little bit. You want to really what we get at here is when applying for a loan or going to buy a house is if your line is here, if your normal is here, you want to keep that line all the way to closing with your finances and everything.
Don't give them a reason to change their opinion.
Don't raise red flags. Don't go buy that car yet. Don't finance that furniture for your new house yet because you're not even closed on it yet, which you shouldn't do. So go. Don't add a ton of cash or don't reduce your cash on hand balances. Don't do that. It's just it makes it a little bit harder for you to qualify with these loans through the lenders. So keep that status quo. Keep that line right down the middle.
Yep. The day of reckoning will come. It's called closing day. You
Relates
got to
to
show up with your cash.
Yeah.
Relates to the next one.
Yep.
Thou shalt not forget to include all debts on application. Mm-hmm. I think Jackson was saying they are people too. They also have really good online tools to catch you if you're trying to hide something. Don't try to hide something.
Yeah.
I just had a closing a month ago, and with these buyers that were just on and off for the longest time. We finally got the house that they wanted because they were gonna offer on it, and then they didn't because they couldn't quite qualify for it. They had to lower some of their debts down and everything like that, and they did. And then that house actually came back on market again, and they're like, we got to get it. So they they finally like pre-approved because the rates went down. Everything just worked out really well. Excuse me. And then my lender, he's a good buddy of mine. He was really sweet to do this, but I later found out after closing, he's like, hey, real quick. He's like, they almost didn't make it. They spent $24,000 on a credit card for who knows what, and they tried not to tell me about it. And I was like, yeah, thanks for not telling me that. He's like, we made it work, but this was like, I don't know how we did it. He's like, but we got them there. I was like, wow. So it made it a major headache, and they almost lost it. They almost lost that house that they really, really wanted because I don't know who it was. Mr. or Mrs. Seller was irresponsible, and I think they bought a bunch of furniture and tried to get away with it. But the good lenders are always keeping up on those credit reports.
Yeah.
And when they see something pop up 3 days before closing, good heavens.
Nobody likes surprises. So just being forthright with your lender.
Be straight up with them. Say,
They're on your team.
yeah, they want the closing just as much as you do. This is their paycheck. And that's a pretty transactional way to think of things. But they make their transaction, they make their paychecks off of serving you to the best of their ability, and they can't do that if you're not telling them everything or you're just telling them wrong information. So keep that. Honesty is the best policy there.
Yeah.
Amen.
All right, number 6.
Yeah, I think that rolls right into it. Just thou shalt not make any big ticket purchases. Furniture is that big one. You're getting a new house. You want to get new furniture. Furniture can be a really expensive purchase.
Yeah.
And if your lender sees, you spent $5,000, $10,000, $20,000, $6,000 on furniture, that can definitely affect your qualification.
It ain't that big. They say nothing over 250.
Oh, you shouldn't. I mean, like I said, keep that line right down the middle. Don't charge anything to any type of credit card.
Taylor Swift tickets, don't do it.
Yeah, get your mom and dad to buy them for you and then pay them back later.
Yeah, the bank wants to see that your lifestyle is still the same. And if you are suddenly upgrading your lifestyle and increasing your spending, they're going to say, hey, this is kind of scary. Yeah. And they might not want to lend you as much.
Go ahead.
I was just going to, let's put it into relativity, right? Like if you ask your lender, what's my debt to income ratio? And that the limit for a conventional loan is like 42%, right? And they say, oh, you're at a 29, then you're fine. Like you got some wiggle room, okay, within reason. But if you ask it's 42% and you're at 40%,
right,
then that's when no concert tickets.
2% is not a lot.
Let's make sure we're being really smart so that our credit card payment doesn't go up, because it's all about the payment. The payment goes up because of extra spending, right? Like that example Spencer gave, then you're going to have some problems there, and you
Good
could
point.
push over the edge.
Stay sane, stay logical, understand the way they use the data, and if you're nowhere near that.
Yep.
Now, I do have to give this side of advice. Your lender is going to coach you on things to do to better your situation as well. So just because the 10 commandments say, hey, don't lower your cash accounts. Okay, well, if your lender says, I think it'd be a really good idea to take some of this cash and pay off this credit card, you should probably do that.
Yeah.
Right? He's trying to he or she is trying to better your situation. So that's one thing is you can't go back and say, well, I was told you can't do that. No, shut up, listen to your lender. They're doing what's best for you, and they're trying to better your situation and increase your debt to income ratio, even if it means sacrificing some of that cash. So with all these 10 commandments, just be cognizant of what your lender's actually telling you to do, because they've got your best interest in mind.
Yep. All right. Number 7 is thou shalt not apply for any credit card anywhere until your loan is complete and closed. Okay, so increasing credit inquiries typically will ding your credit, and that's another thing to ask your lender. Hey, is my credit score on a border where I could go down and have to take a higher interest rate if my credit score goes down, or do I have some cushion there where I can play with that a little bit? And if they say, yeah, you're an 820, you're good, right? You're top tier, you're great. That's wonderful. But if you're at, let's say, even a great score, but you're right on the edge of 741 or something like that, then okay, I got to proceed with a lot of caution, make sure all my payments are happening on time, and I'm not opening anything else up that's new. The other thing that's not listed here is don't close. Oh,
Still
It is,
redundant.
but that's bank accounts. Don't close credit cards. That's the other thing I was going to tell you. Some people think like, oh, should I just stop closing this credit card? It's been trouble for me or whatever. You don't want to close credit cards, even if they're paid off, because that will ding your credit. Credit
Especially
history.
your oldest one, because your length of credit gets factored in. So if you've had a credit card for 5 years and then another credit card for 1 year,
Credit scores
and you
are
close that
frickin' scam.
one for 5 years, you get a big ding.
Yeah.
Landon and I sat in the room right over there taking that course.
That's
and
right.
That's when I realized that I closed my credit card at $60,000 of credit that I'd had for 20 years because I never used it.
During the class, he's like, no!
Went from 850 to 680.
That was really funny. I forgot about that. So it's funny.
It is kind of weird though. I mean, I hate the fact that paying off a credit card and closing it doesn't
I had never
increase,
used this credit card.
but it doesn't increase your credit.
Yeah.
They want to see credit history.
Playing the game. Play the game.
It is a game
Or
for
else you
sure.
get played. Definitely. All right. Number
Is that thou shalt not change bank accounts?
number 8.
Number 8.
Oh, sorry. Gave away the next one. No large deposits without checking with your loan officer. So no.
Unusually
Yeah,
large.
and this, so you got to be careful with this one too, because this comes into like what we're seeing a lot of, especially with the millennials and younger generations, gifts from parents, and it gets deposited into their accounts.
Should I
and-
tell my lender about that?
Well, let's go back to one of these. So if you go back to Commandment 5, thou shalt not omit debts or liabilities from your loan. This can also go, thou shalt not omit deposits. Like you gotta tell them, and you actually have to declare those gifts. But aside from that, that's kind of a side note. Big, large deposits. That's just another red flag.
Yeah.
For whatever reason that is, I'm not sure. You probably know a little bit more about that, but it definitely raises some eyebrows.
Yep.
It
Yeah.
can be a good thing, but don't do
It should.
without telling
That's why I'm like that.
Yeah, just give
you'd
them a
think
heads
it would
up.
be, but
They just need to source it. So as long as there's a valid way to source it, if you tell them, "Hey, I got this shipment, some cocaine money coming in from Colombia,"
Yeah.
that's trouble, right? You can't source that money.
The classic Colombian
Don't do
wire
that
transfer.
anyways. Yeah, just don't do that.
it's
But-
snowing from Colombia.
But like usually income is traceable, right? And there's a way to source that income or that cash so that you can use it towards your home purchase. But yeah, the lender just wants to make sure that like your income that is coming in is validated, and it's not just like, ooh, you got that one big lump sum that one time, but other than that, you're a train wreck as far as cash flow goes, right? So
We've talked about this in previous episodes, the power of the money of the boomers and its value and helping kids buy. That's part of the conversation you'll probably have with your agent is you get prepared to begin the process.
Yep.
Do it then
yeah,
before you've already engaged with the loan. So
And I'll say it again. Like, tell your lender everything, like from birth to now. Like it's just tell them everything.
They won't look
They won't lead you astray.
So number 9, we've hit this a million times. Thou shalt not close or open or change bank accounts. Hit that from every side.
yeah, even your checking accounts. Like I'm just pulling money from Wells Fargo to Chase, right? Because I saw this deal, and this is what happens: is you get a mailer that says we'll give you $750 if you start a new account with us. And so you're trying to ship that over so that you can have that. But that inconsistency of who you bank with, now you've got a different banker, and all of a sudden a lender's like, wait a minute, why are you doing that? Are you going to skip around with us too? Or are you going to, it's like they just wanted to see consistency over time is like the best trait that you can show your lender.
And you have to look at it from the bank's perspective. Someone who's loaning you a bunch of money is going to look at every single thing you do, and it's always they're going to look for liabilities in everything you do. So if you seem like a liability, they're not going to give you a loan. So if you can
comes
stay
down to risk.
consistent, if you can stay consistent, you won't be looked at as a major risk.
Yep.
And so that's what we're trying to eliminate. Last one, what do we got?
Yeah, number 10, thou shalt not co-sign for friends or family, especially, when you're applying for your own loan. Like you were saying, if the bank's looking at it, they're going to say, okay, well, you co-signed on house A, so if your buddy or family member can end up paying, you're going to have to pay the mortgage on house A, and you're trying to buy house B and you can't afford to pay the mortgage on house B and house A at the same time, then you're not going to get qualified. So,
Yeah.
So in another time and day, it'd be great to co-sign a loan. Don't do it when you already have signed for another.
Well, one thing is like, and you were hitting on this, right? But like when you, let's say a $400,000 house, right? Your family member calls you and says, hey, can you co-sign me on this? Because I don't have the income to qualify for this house, right? You are now on your personal financial record, when you go to buy something, you don't have half of that. You have
Exactly.
the full amount,
full.
right? So it's the 100% of the amount shows up on your credit report and their credit report. And so that's why co-signing can be a little bit challenging, because it creates some inconveniences going forward if you're trying to borrow money. So it's that, and you have 100% of the liability. So say that person stops making the payments that said they were going to make 100% of the payments, they stop making it. Now you're responsible for not half, you're responsible for 100% of the payments. So that's why co-signing can be a little bit dangerous. And it's, people have hearts of gold and they do it, you know, and they're nice about it and help family out or friend out. And that's great. You know, just understand the risks that come with that, I think, is the main thing. And I was looking at a duplex when I was in college, and I called my dad and I just said, Dad, this is the best deal. Like, I could do this. And I was at first year realtor back then, and I couldn't qualify on my own because I needed to build up my 1099s to 2 years and have good income for 2 years. And I just said, hey, what do you think about co-signing with me on this thing? And we'll live in one unit, rent out the other. And then when we move, we can rent both of them out and just have some good cash flow from it. And it would have been a great cash flow listing. And my dad quoted this, said, hey,
Which you didn't know until about an hour ago.
yeah. I looked at him like, it was number 10. He said, I think commandment number 10 was, thou shalt not co-sign with on a loan for friends and family.
I
And
think he was being very selective.
If I close my eyes, I can see him saying that exactly. Just see it.
so he quoted the 10 commandments of lending and did not buy that duplex with me. I never bought a house in Utah. And I think he selfishly just wanted me to move back to Colorado. And that's why he did that. But
My dad's a ton nicer than your dad, because my dad,
yeah, he is.
my dad broke this commandment, and then he probably shouldn't have. But the thing is, like what we were talking about with the 1099 stuff, I had made really good income that would totally qualify me for the house that we bought, but I couldn't get the house because I wasn't up my 2 years yet. And so my dad's like, listen, I'll sign it. I was like, Dad, that's fine. Like, I've got down payment, I've got cash on hand, like everything's good to go. You won't even need to spend a penny. But you just had to go through the loan approval process and stuff. And
Yep.
he helped us out a ton and on our first home, and it was a huge blessing. But we broke that one. Turned out good, but
No,
it's definitely one of those you have to be careful with, because even like if it's your own kids, you never know what those people are going to do. Like, they could leave you high and dry, and you're stuck with that mortgage payment.
yeah.
So.
Proceed with caution.
It reminds
They
me
can
of
be
a
good.
quote. Have I ever talked about my stepfather before? My stepfather's very wise, successful guy. He used to say, if you ever need money, we will be here. And then he'd pause for effect, and then he followed with, don't ever need money.
That's awesome. Words of the wise.
That
right
is a
there.
wise stepfather. That's awesome.
You ever need money? We'll
love
be here.
that.
Don't ever need
Don't
money.
ever need money.
I love that. All right. Any last thoughts, guys? Okay. Hopefully you got some value out of this, and listening in. If you are thinking about purchasing a home in Colorado, we can connect you with some amazing lenders that we have that are lending partners that will definitely go over these with you. Make sure that you're choosing some good decisions during the process and having a smooth process on the loan. You don't want to have those hiccups that people have from breaking some of these rules, and it just leads to headaches down the road. So hope you've learned something, and we'll catch you on the next episode. Thanks for listening.